Hello and welcome to Scholar Trading. Today I will be discussing a swing trade strategy called dollar cost averaging. Before I jump into the video, I'd like to invite you to subscribe to the channel, hit the notification button for new content that comes out, and just like the videos. Otherwise, guys, just dive in and enjoy. So, what is dollar cost averaging? Dollar cost averaging is essentially a strategy that takes a specific amount of your liquidity and you divide it into certain percentages so that you can slowly invest in a stock. If you're not too sure of where it's going, you can start averaging down every time it drops rather than you pull out and lose your investment. Okay, so how it works. Number one, you determine the total amount of capital you want to invest in a particular commodity. So in this instance, let's use a nice round number of $10,000. Divide that amount by 4 to determine the size of each tranche. So you take $10,000 divided by 4, that's $2,500 per tranche, right? So that's a quarter of your entire amount that you're willing to put into that specific stock. So number 3, use the first tranche to purchase the commodity at its current price. What that means is, let's say for example, I'm going to use Berkshire Hathaway, right? I'll show you guys the charts shortly. You invest at a specific price of, let's say, $230. Okay? What you want to do is wait and don't put any more money into that stock until you start seeing a significant movement. If it starts moving down a specific amount of percentage, you would want to add the second tranche, meaning the second quarter of the total amount you're willing to invest in that particular stock. Number 4, monitor the commodity's price and wait for it to drop 15%. So personally, that's my rule. I like to wait 15% if I'm doing a very long-term swing, right? That's typically anywhere between 6 months to a year. Could be 2 years, actually. Anywhere from that range. Ideally, it's so that you capitalize on the largest moves. And once the stock starts coming down and going lower than your original price that you entered the first time, you're able to average down. Okay, so once the price drops 15%, use the second tranche to purchase additional shares of the commodity at a new lower price. Basically, you just repeat steps 4 and 5. Every time it drops 15%, add another quarter to it. So your first $2,500 at 220, let's say, you add another 2,500 when it drops 15%. As a beginner stock market trader, you may be intimidated by the seemingly unpredictable nature of the stock market itself. But by utilizing a strategy such as dollar cost averaging, you can take control of your investment decisions and reduce the risk of significant losses. Dollar cost averaging involves investing a fixed amount of money into a stock market at regular intervals, regardless of the current stock price. This strategy allows you to average out the cost of your investment over time and reduce the impact of market volatility on your portfolio. By investing in increments, you are buying more shares when the price is low and fewer shares when the price is high, which can help reduce overall cost basis. Personally, I wouldn't be adding more money when it goes up because ideally this is kind of take profit territory, and we'll get into that in a few slides. So, to effectively utilize this strategy, follow these simple steps. The first one, determine your investment goal, right? So like I said before, 10,000, let's say where you start, that would be a good liquidity to kind of utilize for a specific stock to do the drop-down average. Okay? Before investing in the stock market, it is important to determine your investment goal. Are you looking to build wealth over a long term, or are you looking for short-term gains? This will help you determine the amount of money you want to invest at the length of time you want to invest for. So, swing trading, we're looking to take profits. All right, we're not going to be looking to just keep piling money in when the stock goes up. That's averaging up, and averaging up is not a good strategy to take. When your stock starts climbing, start looking for a new and different opportunity. Don't ever keep throwing money into a stock that's going higher, especially for a short term or even a long term swing, right? When it's for a very long term, we're talking 5 to 10 years, then at that point in time, if you're really married to that stock, yes, it would be kind of wise to every small amount of money. You could buy a share here, buy a couple shares there. Yes, that would be a wiser decision to do. But we're looking for more short-term gains with these strategies, okay? So, number 2, create a budget. Determine how much money you can afford to invest each month. This will help you determine the size of each tranche you will be investing. So, like I said, overall, you want to have a fixed amount that you start with, right? But ideally, over time, you're adding to your account to build a liquidity for yourself, so you're not married to just one or two stocks. You're able to diversify the longer you're in the market. Number 3, choose a stock or ETF. Decide which stock or ETF you want to invest in. Consider factors such as the company's financial health, the industry it operates in, and its historical performance. So, to sum it up, I have a fundamental analysis 101. Go watch that video. It's going to be very helpful. Number 4, start investing. Start investing your first tranche into your chosen stock or ETF. Self-explanatory. Number 5, monitor the stock price. Keep an eye on the stock price and wait for it to drop 15%. When the price drops, invest your second tranche. Repeat this process until you have invested all the money you had set aside for the stock market. Now, when I wrote that, I don't necessarily mean the stock market itself. I mean the chunk of money you set aside for that particular stock, right? I'm not saying to just keep throwing money and see what sticks. That's not going to be ideal here. Okay, when you average down 15%, what you do is you take the original price that you bought on and you buy the same amount of or use the same amount of liquidity to buy shares at a lower price. You average those two costs out. Okay, now it's not going to sound exactly that simple because we could do the math. Let's say you bought it at 200 the first time and then drops to 175. Okay, so that doesn't mean that your average is going to be 187.5 because you essentially bought more stocks for the same value that you had at 175 compared to 200, right? So let's say, for example, you're able to get, I don't know, let's say 5 extra stocks for a lower price because there's a $25 difference from that high to where you're currently buying it, okay? That's going to actually increase that portfolio size more than just that extra quarter that you added, because the quarter of liquidity added to that particular stock, when it drops, you're able to purchase more shares. Okay? So, number 6, be patient. The trader's worst nightmare is lack of patience. Okay? Again, there's fundamental videos that I created before. One of the key videos is the mindset video. I'll link everything in the description. Please, guys, watch it, okay? It is extremely crucial. You get your mind right before, quote unquote, playing with your money, okay? Dollar cost averaging is a long-term strategy, and it is important to be patient. Don't be discouraged if the stock price doesn't drop as you expect it to. Remember, the idea is to average out the cost of your investment over time. Right? So if you intended on just getting in and then the stock dropping so you can buy more shares, and it just starts climbing, I mean, don't fret. That's not a bad thing, actually, right? Later on in the slides, I'll explain when to actually take profits. Okay, so number 7, rebalance your portfolio. Regularly review your portfolio and rebalance it if necessary. Pardon me. This means selling some of your winners and buying more of your losers to ensure your portfolio remains diversified. Yes and no. So yes, in the fact that you want to average down on stocks that are dropping harder just to make sure you buy them at a lower price, and your winners to start kind of scaling back in what you invest in them, because as the stock gets more expensive, it's going to cost more money to buy the same amount of shares, right? Whereas your other stocks, if they start dropping, they're going to be at a cheaper price to average down with, right? So plenty of good examples out there, like Meta, like Netflix, like DocuSign. They were at massive peaks. Like Meta's peak, I think, was what, like 400? We'll get into them in a second. Netflix's peak was 700. DocuSign's was around the $400 mark. They've dropped significantly. Okay, so if you were buying near the peaks, and you didn't want to sell, let's say that high, and now you're like, oh my gosh, my portfolio's down 70%. You should have been averaging down. Right, and this is where you're going to see that every time you get some liquidity into your funds, put it into those stocks that you know they're not dead sticks. They're still going to rebound, but it's going to take some time. Okay. So by following these steps, you can effectively utilize the dollar cost averaging strategy and reduce the impact of market volatility on your portfolio. It is important to remember that no investment strategy is foolproof, and there's always risks. There's always a risk of loss. However, by taking a systematic approach and investing regularly, you can build a strong portfolio over time. So here's Berkshire Hathaway. All right, now just as an example, I brought it right before COVID of 2020, okay? And I was saying about $220, so let's say right now it's at $224. Let's say this is where you invested, okay? You put in $2,500 right at this point. First investment. All right, done. So now, what are you going to do, okay? You're going to wait for this stock to either go up or down, and I'll explain how to take profits later on in the video. But right now, we want to learn how to mitigate our damage. So as you see right now, jumping in at this point after all this kind of movement, it seems pretty lucrative, right? I mean, it looks like it's peaked. It's the highest it's ever been at around 224. The previous high was 218, then 222, right? So, I mean, it looks like, hey, it could possibly be a resistance because it bounced off there the first time. Whatever the case may be, you're a new trader, you jump in, $2,500, your first investment there. And then you give it some time. It's kind of bouncing all over the place, hasn't gone anywhere. Oh, here we go. Now it starts to drop. All right, and pretty sharply. Like we want to say, kind of know where it's going to be going, right? But for all intents and purposes, let's just play along. So you invested at 224 and wait for it to drop 15%, right? So that would be around here. So you shouldn't be entering with your next quarter until it hits $190 valuation. So let's see. Okay. Oh, that came close. So you see on this day, I mean, even if it was, let's say 14.5%, it's really up to your discretion at that point. But once it hit that point, I would have added another quarter. We'll just put in here at 224. Okay, so now we added another one right here. Okay, at second 2,500, second tranche, what did I say, 194, right? Approximately 192, let's say, 192.50. Okay, all right, so now when we added our second tranche, right here at 192, when it was approximately down 14 and change, okay, we've averaged down our total investment to $208.25. So we're going to write that in here as well. Averaged down to 208.25. Give it a dollar sign. Wonderful. Whoops, shouldn't have pressed enter. Okay, average down to that. Good stuff. So now let's continue. All right, so now I'm going to pause the video once more, or pause the charts, get this out of the way. All right, so we took it at 192, correct? So where was that? Right about here. So now let's see another 15% possible drop. Yes, right here. Okay, so 163, that is our next tranche that we drop in. 2,500 at what did we say? 186, was that what it was? No, 168. 168. Approximately, right? We're gonna just say it was around there. Okay. So now we've put in 1, 2, 3 out of the 4. Okay, so the total amount of the stock actually dropped more than 30%. However, because we've invested there, you can see it dropped, well, no, it dropped about 28% total. However, the first drop that it had, that 15% or 14% as we take the trade, was right there. Okay, so from this point on, it's another 15%, not from your original entry. That's just what I want to be clear on, okay? So we will take from here down 15%. All right, so even still, we'd be looking at 164. Now, the only unfortunate thing, let's say that one day of trading didn't happen, you'd lose out on being able to average down with these 3 wicks here. Okay, so I would have grabbed it, somewhere around the bottom there at 13%, quite possibly. All right, so now what our average is 224 plus 192.50 plus 168. Divide that by 3. And now your average price for your position is 194. .83. All right, so there we go. Which means you originally invested at 224. You took your first position down at 192 to average down. You took your third position to average down, almost where you grabbed your second position. So now look where we are right now. Okay, you've averaged down and you're sitting at what, 194, correct? So you are about right here. This is where your position is. 194.83, right there. Okay, so you picked it up right there. You averaged down to get to this point. So now, when the stock starts climbing again, right, and like again, it didn't break the new low, so you're not averaging down again, okay? And now you see, you broke even, up a little bit below, but again, you're waiting on that 15% rule from your last low, not because you hit break even and it dropped 15%. That's not what you want to do, okay? So now, since we started climbing out of that hole a little bit, when is the time that you want to take profit, okay? Let's dive into that after the next segment. Now, taking profit. Here are some guidelines for taking profits when using the dollar cost averaging strategy. Number 1, set a profit target. Before you invest, determine the level at which you want to take profits. This can be based on a percentage gain or a specific dollar amount. For example, you may want to take profits once your investment has increased by 20% or if it reaches a certain dollar value. Right? So in the case of Berkshire Hathaway, we'll dive in to see from our averaging down how much that actually ends up being. Consider market conditions. Take into account the overall market conditions when making a decision to take profits. If the stock market is in a bear market and the stock you are holding is underperforming, it may be a good idea to take profits. On the other hand, if the market is in an uptrend, it may be better to hold on to your investment and wait for a more favorable time to sell. So just remember, the rules that you set for yourself are going to be very, very important. If your goal always is to take 20% no matter what, but the stock is in an uptrend, so at that point in time, there's another rule that you could set for yourself where, you take 70% of the share out, so you secure your profits and you just leave 30% of your initial investment in. So, for example, you put in $2,500 and the stock just kept climbing. And you're like, well, I'm not going to be able to average down, but I mean, hey, I could take quick profits on this pretty easily. So rather than pulling all the money out, let's say and earning, what would be 20% on 2,500, let's see, $500, okay? So rather than pulling out all the $3,000 from the account, you would pull out 70% of that total revenue, which would be $2,100, and you would leave $900 left in that particular stock to see where it goes, okay? And what you would do at that point is take your stop loss and set it at your original entry. Okay, so what you did right now is you secured your profits, and if the stock ends up pulling back and it hits you at break even, you've already secured 70% of that 20% gain, right? So once it hits break even, hey, you know what? You tried to run, but it didn't happen. You didn't lose anything. You still secured your profits. Okay, that is the key to swing investing. You need to secure profits. So review your portfolio regularly. Regularly review your portfolio and assess the performance of each investment. If one of your investments is significantly outperforming the others, it may be a good idea to take some profits from that investment and reallocate the funds to other investments in your portfolio. So great opportunity, right? Let's say you have, let's say 10 stocks, okay? And you've done this strategy multiple times by now, and 5 of your stocks are performing very well, one of them is performing very poorly, and 4 of them are kind of just middle of the road. They're really not doing a whole lot, okay? So the one that's performing poorly, you take a little bit of profit from the ones that are performing well, and you average down on the one that's performing poorly. So you might be saying, hey, but I already used all 4 quarters of my liquidity to put in that low performing stock. I'm like, okay, so you have one of 2 options. Number one, you can take profits from your more profitable stocks and kind of add percentages at that point with kind of the same amounts that you've been doing, or cut your losses, right? The averaging down will work if the stock you have done research on before, you know it's going to bounce back, you know that there's future for this particular stock and company to grow. But if the news has been poor for the last several months, if let's say they're selling their shares internally, they're turning into a meme stock, or they're just becoming popular for all the wrong reasons, perhaps it's time to cut your losses. Right? Nobody really wants to get rid of any stocks that they have, especially at a loss, but you got to make that smart decision. You got to cut that cancer out before it infects the rest of your portfolio. And all you do is keep doubling down on a stock that's turning to garbage. Okay, there's stocks out there that were valued at $11,000 and now are worth like 25 cents. You know, you got to know at which point how much it drops to just cut the cord. Okay? And with that 15% average, I mean, yes, you're risking the stock to drop a total of, well, I wouldn't say 60% because it's 15% from each time you average down, right? So let's say from that peak, you're probably looking at maybe 45 to 50%. If it drops lower than that, you know, it's really time to assess, is this stock ever going to recover, or is this a dead stick? Okay, so always keep that in mind. But at the same time, because you're going to be diversified, one bad apple in the whole bunch could potentially ruin them all. However, you know, cutting away and tossing that bad apple, you will preserve the other 9. So, leads us to number 4. Don't be greedy. It's important not to be greedy when taking profits. While it can be tempting to hold on to an investment in the hope of further gains, it's also important to lock in some gains and reduce your risk exposure. So, like I mentioned before, right? Once you are in a secure profit margin, take some profits, leave the rest to run. If it doesn't run, goes out to break even. You lost nothing, you made some gains, right? You always want to lock in. Greed is going to be your hardest emotion to overcome. All right, especially when you're in a profit already, you'd be like, oh man, it's going to be amazing. And then after market news comes out and the stock drops 20%, but you can't close it off. And you're like, oh no, instead of breaking even, I'm actually going to lose this. Not great, you know? Always lock in your trades, especially when you know there's going to be some volatile action coming up. Earnings can be volatile. If you've been following that company, you should know if the earnings are going to be potentially good or bad. You should know how that's going to impact that potential stock. Lots of factors. Okay. And number 5, before pulling profits, consider your tax implications. So, I mean, when you're swinging, you're not really going to care a whole lot. You're still going to have to pay capital gains on what you've made. But just remember, when you do the long-term investing, you don't have to pay until you pull it out. Okay, long-term swings you will. especially when you make a good amount of profits. So just keep that in mind before you start spending your profits away. Set some aside for yourself. Read the tax codes just to make sure you don't screw yourselves over. All right, so now let's jump onto the chart. All right, so back to the chart we go. So from the previous one, we had our investment originally here at 224. We've averaged down the first time, then we've averaged down the second time. So for our average position price, this is actually what it's going to be at, okay? So the way that I wrote this is the time that you average out at these prices. So the average down to that particular price would be correct. However, because you've ended up buying more stocks at the discounted price, your average down is actually lower than what it says here, right? So let's do a little bit of math. I'll throw out a text box, okay? Just bear with me, guys. So let's say 2,500 divided by 224 means you got 11.16 shares. So let's just round that up, 11 shares initially, right? Plus, I'll just press enter for that one, okay? So then you bought the second tranche at 192. So that's 2,500 divided by 192.5. So then you ended up buying 12.98, so 13 shares. All right. So now you've averaged yourself 11 plus 13 shares, which means that the actual price that you've averaged down to is lower because you ended up getting an extra 2 shares at that price compared to your original investment. All right, so we'll do that math in just a second. Your third tranche, you got 2,500 divided by 168. You ended up buying 14.88 shares, so let's just round that up to 15 shares. So now you have a total of what? 39 shares, correct? So now your original price of 224 plus the 13 plus the 15, right? You actually ended up averaging down lower than what I have right here at 194. Now, the way to get our average price, and again, most brokerage programs do this for you, right? You'll be able to see what you've averaged down to. But in this case, we have 39 total shares, okay? The total amount of money that we've invested here ends up being, let's just do the quick math right there, 224, we ended up buying 11 shares, right? Times 11 equals 2,464. So we'll throw in another text box. 2464. That's our first one. All right. The second one, we got 13 shares at 192. 192.5 times 13. Cool. That's 2,502 and 50 cents. All right. So now the way that we do the math is we add these two numbers together. So 2464 plus 2502.5 equals 4,966.5. All right, so now what you do is you take your 11 shares plus 13 shares, the total ends up being 24 shares. So now what we do is we take 4,966.5 divided by 24 equals $206.93. So as you see, this average down is a lot better because you ended up getting more shares at a lower price. So it averaged down to 206.93. Excellent. All right, so now just to remember that, right, that's our total number. So now we have 4,966, and then we've bought another tranche at 168, right? And that ended up being 15 shares because we did the math on that one. So 15 times 168 equals 2,520. Okay, so now we take that number plus 2,520 equals 7,486. So, like I said, right, 7,500 is where we should be at. So we're pretty close to that number. We're 14 bucks off. That's okay. You can't really buy partial shares in certain stocks. So 7,486.5 equals, or enter, sorry. All right, so there we go. That's the total number. 7,486. So now what's our total here that we added up to? It was 39 shares, right? So now divided by 39 equals 191.96 is your true average down. Which brings this bar slightly lower. So as you see, you've actually you've done a lot better than what you would have originally thought. Pardon me. By taking that average, because you're able to buy more shares at a lower price. So here we are. Okay, now let's just move this all down so it doesn't really get in the way. So now this is our break-even bar. When we want to climb to there, that's going to tell us, hey, we've broken even. Should we sell just to get out? It's Berkshire Hathaway, guys. They're not going anywhere. They're going to do well. All right. This is what I'm saying by just make sure you're doing this kind of strategy in an already established stock. It's not really going to work if it's like Neo. I don't want to throw them under the bus, but I mean, let's be honest, right? I mean, trying to average down with them is just like throwing turds at a wall. It's not going to end well for you. And it's going to be a big mess to clean up. Okay, so now 20% from 191.6 to take profit. Where's that going to lead us? Let's see where 20% is going to go. 20% is at approximately $230.41. So now let's wait. Almost. Oh, it's dropping again, but that's okay. Sometimes it takes a while, right? But we'll see where it goes. And there it is. So right here, that would be the first spot to take profit in. All right. Sorry, guys. Cough and dry throat's really bugging me. But anyway, so now it went from 191 to 220, 230.28. Okay, so divided by 191.8 equals, so you've made yourself that 20% increase. All right, that's exactly what we're looking for. And you know what? You've now taken 7,486, right? Because that's the total amount of money that you added as per our little chart right here. Okay, and now you've made 20%. So just by being patient and scaling down every single time that this dropped, you've now taken your stock value to be $8,983, which means that you've gained a net profit of $1,490 approximately. Okay. Let's just, let me redo that one for a second just to make sure I get the correct number. 7,486 plus 20%. 1,497. You made $1,497 in profit because you scaled down, right? Now, yes, it'll be unfortunate if the stock goes up. You're not going to be able to average down and then make a larger gain, right? But now look how long this took us. From the first initial point of dropping right here, February 3rd, 2020, to make profit was November 16th. So that took almost an entire year. However, you made a profit for nearly the exact same price where you first invested in. That's pretty good, isn't it? Okay, so you've increased 20%. You made $1,500 on $7,500 approximately. However, like I said before, if you take everything out, that's the profit that you keep. Okay, but now you take 70% of that profit out, right? So let's just do 7,986 plus 20% equals minus 70%. So you've taken out 6,700. All right, and you've left a total of 2,800 left to ride, if that's what you want to do, right? Otherwise, it's going to sit here to break even. You're not going to be out, but you're still going to be in profit overall, right? Because even break even, it's break even. You haven't lost anything, but you haven't maximized your profit, okay? So now we're leaving 2,800 to ride right here at about this point, okay? And we'll see where it goes, because your break even is 191. So I'll speed this up to times 10, and let's see what happens. Just gonna fill some dead air. I know you don't want to hear me sing, so I won't do that. Now look at that. You see? Isn't it nice to just let some of your profit run? You took majority of your profit here. This is all bonus money. Okay, so now you've taken 2,874. Let's say you let it ride all the way until it started consolidating. How much of that is a percentage gain? Let's say plus 25%. So you've made $718 on what you've left in there to let ride, which means that what you now have left in that particular stock is 3,593, right? And you've already secured 6,700 in profit. So now you've been in this trade for approximately a year and 3 months, because now it's May 18th. So this total value, you've put in 7,486. Now you have a total value of 10,293. So how much is that, let's say, right? So 10,293. So that is 28% profit overall from your investment of 7,486. Now again, it's a slow way of gaining some profits, but that's just one stock, guys. Okay? This is one stock, leaving it in a long-term swing. You've averaged down, you've secured profits, you've taken those profits and you can move them elsewhere. It's a fantastic way to go. Okay? So now, after you've done that, you can let the rest keep going, right? And let's just see how it goes. You can pull it out, you can let it keep going. It's completely up to you what you want to do, right? This is all pure profit at this point. All right, so you can see it kind of double topped here. I'd be kind of nervous in leaving it longer. Look, triple top at this point on the daily. But at the same time, it also triple bottomed, right? So it just looked like it was there temporarily. Now look at this gain. Holy bonkers. Look at it go. Now we know 2022, right at the end of the year, was kind of the peak. So I'll pause it. Okay, and we're coming up to where we're almost at now. But now you've seen where you've averaged down to 192, right? If you're not nervous and you don't care about securing profits with a stock like Berkshire Hathaway, for example, this is where you'd be sitting at right now to where it got its peak. You could be 86% in profit. Okay, so 7,486 plus 86%. So if you would leave it a little bit longer for 2 years, let's say from your initial investment, look, February 2nd was right here, but March 28th. So just a little over 2 years right here to where it's hit its peak in March 2022. Your account would be at about 14,000. So you would have nearly doubled your investment. Okay? And then what can you do at that point? Take out your initial investment of 7,486 or 7,500. Now, everything that's in this stock is pure profit. Pure profit. Okay? Watch what we do right now when we hit this point. 15% drop. From 360 to 305. What do we do, guys? Put in another quarter? May as well. Everything in there is pure profit. Right? You could take the original value of the stock, double down on there, and there you go. Now you've averaged down even more. Now 15% from that point. Look, almost had its low of 263. Right? You could have waited. It could have went back up there, but then it hit almost that 15% right here. So either way, that would be the ultimate low. Look at it go now. Okay, so where's Berkshire Hathaway sitting? It's right there. Okay, so again, I'm not going to do the math, but as you've seen, you took pure profit, so you spent no money. The original stock they ended up buying in was around 306. and then you bought another batch at 262, right? So let's say your average from 306 to 262 based on the amount of stocks, let's just ballpark 280, okay? 280 would be about right here. From 280 to where it's sitting at right now, you've made another 10%. You made 10% profit, right? Pull out your original investment, keep your profit in there. Now, everything that you have in here is almost $10,000 of your initial investment, and it's running risk-free because you've taken out all of the money you put in originally, and everything in this stock is now 100% profit. So that's how the strategy goes, guys. But as you've seen, it takes a while. You know, this takes 2 years to kind of get to its proper maturity phase, to where you're trading strictly with profit on the same amount that you would have invested in. But guys, 2 years to double your money that you put into one stock. Okay? Do the research, and this is going to be a very successful strategy for beginners. Absolutely. If you're a little bit more advanced, yeah, options are another thing to do, but this overall, it's a very good way to go if you want to be in the market, maybe check on it a couple times a week rather than staring in front of the computer screen for 8 to 10 hours a day. Okay, guys? So back to the slides. In conclusion, taking profits is an important part of the dollar cost averaging strategy. By setting a profit target, considering market conditions, reviewing your portfolio regularly, and not being greedy, you can effectively manage your investments and maximize your returns. However, it is important to remember that taking profits is not a one-size-fits-all approach, and each investment and market condition is unique, right? As you just saw. It is important to make informed decisions and seek professional advice if necessary. So, thank you guys for watching the video. I appreciate all the time that you spent in supporting this channel with your likes and the new subscriptions and passing along the message to your friends, because everybody should know how to spend and invest their money. Right? That's what you're doing, right? Okay. Well, good luck, traders. May your investments bring you success, and may the market be in your favor. Remember to stick to your strategy, stay disciplined, and never stop learning. Happy trading, everyone.